Good morning, ladies and gentlemen. Well, on Tuesday we have the CPI, which is going to be quite key in determining what the dot plots and the decision of the Fed is on Wednesday. So without further ado, let's have a look at what could change in the dot plots and the economic projections and how that will influence the bonds, the yield curve, and all other assets as a result. Now, at the March meeting, these are the economic projections that the Fed laid out. Let's not forget that we were in the middle of the banking crisis, so it's natural that they lowballed it. And now that we are out of the banking problems, they are likely to revise all these figures up. The real GDP, well, it's almost impossible that in December we're going to have a 0.5 GDP because we're already in the middle of the year. A 0.5 GDP, if they kept that projection, would almost imply negative numbers from now on. The unemployment rate at 4.6, also extremely unlikely. That has to be brought down, just like the December projection for GDP has to be brought up. And the December projection of 3.1 for PCE inflation is also unlikely. It really has to be brought up by at least 0.2 or 0.3 to make it in line with what reality is going to be like. The core PCE inflation is the one that is probably not going to be brought up that much because it's possible that we get something like 3.6, 3.7. Certainly a number in the threes is possible, but certainly all the others need to be brought up, and therefore the dot plots will also change. What will also be very interesting is to see if their projection for 2025 of PCE inflation and core PCE inflation is still 2%, because that influences the shape of the yield curve. If they now start revising the 2025 numbers up to, say, 2.2 or something like that, that will tell you that there is very little chance that they are going to start easing in 2024 even, and therefore the yield curve will react appropriately given the huge amount of funding that's happening, but also the fact that the yield curve should no longer discount that they start easing in 2024. If the yield curve starts discounting that, it'll completely change shape, and we will discuss that later. But these numbers for 2024 are going to be, and 2025 are going to be just as important to me as the number for 2023. So let's discuss what they could do. Well, we have no idea whether they're going to hike or not, but if they want to signal a skip rather than a pause, or indeed a pivot, they need to bring up these dot plots to around 525, 530, 535. So this big line here of people projecting needs to come up by 25 basis points, because that will signal that a hike is coming in July, and they are just skipping the June meeting. This will, of course, depend on the CPI number, but unless that is very cold, and I mean very cold, these dot plots are going to move higher. That will signal that even if they didn't hike in June, they will certainly hike in July. Now, if they do hike in June, and these dot plots move to around 5.5%, that is a signal that they're going to hike some more. And then I think that all assets are in trouble. but this is going to be naturally absolutely pivotal. But also how far these dot plots start coming up for 2024, 2025. I would expect each of them to come up by about 25 basis points. That means less cuts in 2024 and means less cuts in 2025, all of which naturally is going to impinge on the 2-year note by far the most, and everything else less. So this was the shape of the yield curve approximately at the last meeting. 310 is as close as I can get it. As you can see, the bonds, the long end, is about 20 basis points higher now than it was then, and the very short end is approximately 12 basis points lower than it was then. This is still a function of the problems that we've had with the banking sector, but I would have thought that if the dot plots are hawkish, this has to completely reverse, and we need more flattening of the yield curve. This is a chart of the 1-year note, 1-year bill, and we have basically taken out all the easing that was implied by the banking crisis, and we are back to exactly the same level as we were before it came about. Now, to me, it would be logical if the 2-year note started following the same path, especially if the dot plots are hawkish. I think dot plots anywhere around the 525 to 540 area would imply that they are going to hike again, possibly twice in 2023, and then it'll be absolutely key to have a look at what the dot plots are for 2024. If those move up even by 25 basis points, then we have absolutely no reason not to believe that the 2-year note is not going to go to at least 475. If you look at the maths, it really does pay at the moment to be in 2-year floating rate notes, because if the Fed is going to hike at least twice again, if the dot plots imply that for this year, and postpones the easing in 2024, then there is absolutely no reason not to be getting 540, 550 on your money for a year. The forwards make no sense at 450, 460 in the 2-year. It has to be 475 and higher for the mathematics to make any sense. And therefore, I really don't see anything but another major move higher in the 2-year note to at least 475, if not to 499, and a further flattening of the yield curve. I know that I've been flip-flopping on the yield curve, but I've been flip-flopping from it's not flattening anymore. I've never ever wanted to go the other way, i.e. to think that it's going to steepen. Steepening of the yield curve, if they move the dot plots up, especially for 2024, makes absolutely no sense, because the 2-year note is going to get absolutely creamed, while the rest of the curve should even like it. The 30s have been stuck in this range, and while they might go to 405 or something like that on a reaction, I expect them to start doing better the more hawkish the Fed is. The more the Fed says it's going to hike twice in 2023 and not cut or cut later in 2024, the more I would expect the market to start discounting that an accident is very, very possible in, say, the economy and therefore the equities, and to start buying the long end as protection. The only place you can hide from a Fed that wants to wring out inflation and is going to keep rates higher and longer is the long end. There is no other asset that I can see that can give you any kind of protection. Now, is it 30s or is it 10s or is it 20s or is it 5s? That is that is something that you can argue about, but it's not an environment where the yield curve can steepen. It just isn't. So let's have a look at the yield curve. These are the 2s, 10s. And after buggering me about and basically making me get out for no reason, we are again flattening. We have broken this level. Now the next level, I guess, is here, closing the gap to around 88, 89 basis points. But if the dot plots are as hawkish as I expect them to be, and naturally I'll wait for them, I really see no reason why we're not going to go back to 107, 108, even temporarily. If we look at then the 2s, 30s, that has broken higher, and really I'm expecting at least to touch 88 basis points and close this gap and match this previous high. To me, this is going to be key, and it's going to be the level that I expect us to trade as soon as the dot plots come out, if they come out the way I've told you. Anything around of an average for 2023 of 5.25 to higher, i.e. 540, implies at least one and a bit hikes, i.e. that the irrespective of whether they've hiked on Wednesday, what it's saying is that there will be another hike and then a high probability of yet another this year. Why would you want to buy the 2-year note and fund it negatively in the teeth of huge issuance? This just absolutely makes no sense whatsoever to me, and therefore the flattening path of the yield curve is the only one I can see. Now, whether they're going to be little reactions lower or on technicalities, I don't know, but it just doesn't make any sense that we should start flattening. It's far too early. We need to peak first, and we're not even discounting the terminal rate. If the terminal rate is still another 40, 50 basis points higher than we are now, and it's going to be around 5.5%, then the 2-year note has to get absolutely destroyed. Especially if the 2024 dot plots are later with the prospective easing for 2024. Nobody is going to hold the 2-year note, and we can have a look at it again, sub this area, because it's just running out of time. The 530s has also broken, and it's flattening. I would expect it to trade around this 11-12 area and possibly even fill this gap. But I think that once that is over, that is the part of the yield curve that will start steepening. The way I'm looking at this is very simple. The more they push out the dot plots and the easing, the bigger the danger that we are going to have an accident at some stage, and therefore to bring in the easing. And to me, the 5s are going to then have enough duration and have enough of a probability of easing sooner rather than the Fed thinks. And therefore, in this area of 530s, I think it's almost, the odds are tremendously in your favor that that part of the yield curve then starts back steepening. In this area of the yield curve between 2028 and 11, I'm a big buyer of 5s and seller of the long end. I think it's almost the odds would be far too good to not do it. The same applies to the 10s, 30s. I think if we see any move to fill this gap towards zero, that is going to be a wonderful opportunity. 10s, 30s at zero is almost always, I mean, I've never lost money by doing 10s, 30s at zero. So if we get a move to around this area, I'm going to be a big buyer of 10s over 30s and just lock it away, because at some stage you're going to make 20, 30 basis points without any problem. So the very front of the yield curve, no, it's going to get worse. The middle part of the yield curve, at some stage, the 5s to 10s area is going to get better, because the odds, if they are hawkish and they continue the hawkishness into 2024, at some stage that part of the yield curve is going to perform very well against the long end. The long end will perform the best in the short term and get us to these levels, okay? And then the odds are completely reversed, and it becomes the other way around, that we start steepening in the 5s, 30s and 10s, 30s from these levels. So let's have a look once more in the individual tenures so you know what the levels are. To me, the 2-year note has very little value before 475. And it might even get up to 499. This is the area where it could start having some serious value. 5s, again, I would expect that around 407, it's going to be very difficult to get much through it. It could get a little bit through it, but you know, around this 415, 420 area, I think it has value, because again, the odds start going the other way, that further out, i.e. in 2024, we start having an accident. Or, you know, it might happen in 2023, but I think the value will be there at around the 420 area for sure. I will definitely be a buyer at 420. If we look at 10s, 390 to 399 to me has value. If all they've done is moved the dot plots up by 25, 30 basis points, 35, this area definitely has value. If they move the dot plots up to 4.5 and higher, which I don't expect, I don't think anybody expects, then all bets are off, and the 2-year note is even higher than the highs. I think you could easily retest, 508, but I really don't expect that, because I don't see why they would do that. The real rate that they would be implying, I think, would be far too high. And if we look at the 30s, I think anything in this area has value. The more they are hawkish, the more the 30-year will like it. So on a hawkish Fed, you don't sell 30s. You sell 2s, you might sell 5s, you might even sell 10s at a push, but you definitely don't sell 30s. I think that this area, if you see a spike up to 405, you just have to buy it. With all the drama that's coming in the US, the German yield curve has been very, very steady. Nothing happening in Germany. Very tight ranges, just ping-ponging about in every single tenure. This is the Bund, it's doing nothing, much the same as the Schatz, which is still, I think, projecting up towards this 340 area. And the Bobble, which really is in a very tight range itself, but I think the odds are that we go and test at least the 270s. The flattening is much less pronounced in Germany. And if we have a look at the differentials, you will see that everything is being pushed slightly out, twos. Basically, we did nothing, but still the tendency at the moment is to get to these levels, which are going to be sell levels, around the 118 twos, around the 160 level in fives, and around the 141, 145 level in tens. Now, why should this happen? Well, if the Fed is hawkish, we're going to be here quite immediately. And then the same hawkishness will be expected from the ECB. Don't forget that the ECB has more rate hikes to do than the Fed, for sure. And therefore, these moves will be replicated in Germany just from higher levels of the differential. So when the differential gets to these levels, I expect the more bearishness in Germany and a return down to the lower levels. I certainly can't see tens above 152, 153. That makes absolutely no sense at the moment with the relative position of the yield curves, and therefore it reinforces my belief that there is value in the US at the higher levels that I showed you. Since I'm still expecting the differentials between the US and Germany to start to keep on going out for a bit longer, I still am looking for higher levels in the Dixie, and I would be surprised if the Fed is as hawkish as I think that they will be, and they take the dot plots out to above 4.25, implying at least one more hike, if not two, for 2023. And if they also postpone the cuts in 2024, which they had priced in before, I would have expected that would be dollar positive, and we would be testing these upper levels in the at least this 104.68 level, let's call it, in the Dixie. I don't expect much more because, as I told you, after that I expect the dollar to turn, because I expect the interest rate differentials to turn, because the ECB is going to have to start raising rates. And if I'm expecting 2 rate hikes from the Fed and I'm expecting 3 from the ECB, at some stage that turns the dollar. But I think the initial reaction has to be higher towards this 104.68 level, and then a failure there, and then back down towards 101.92. But next week, I think that we are going to test the higher levels after the Fed. Well, gold also depends on the Fed entirely. I think if the yield curve keeps on flattening and the dot plots move to into the 430s or 440s, God forbid, I then don't think that gold can remain at these levels. I think it belongs down in the 1881 area, where all these weekly moving averages are, and this very strong support. But if the Fed disappoints, it's going to go up a hell of a lot, because it'll be driven both by the fact that the yield curve will be steepening and the fact that the dollar will be falling. So really the risk reward in gold at the moment is not that high at this level. I still expect it to break the 1959 area and to trade down to 1881. But if the Fed disappoints, it's going to go up to 2045 in no time at all. It's just the way the market behaves. So I am very, very small short. I will continue to be very, very small short. But if the Fed disappoints, I will be very, very quick to cover. Not much to see in DBC. It's still in no man's land, as is oil. I would expect At some stage, we will trade the area that I keep on talking to you about, 2175 down to 2058. And that, to me, the risk reward there is very much for an upside move back to at least 2439. Now, if the market expects the higher interest rates to have an effect on the economy primarily, rather than, let's forget about inflation, let's talk about the economy, and they will, therefore the demand for commodities is going to go down. This is entirely possible in the course of next week or the next 2 or 3 weeks, that we go down and test this 2053 area. I think from there on, just like I said, that when the bonds reach certain yield levels, the yield curve could then very easily start steepening, but not from here, but from those levels. I think that that is a likelihood that DBC does the same thing, that it starts going up, but not from here, but from these levels, for exactly the same reasons, i.e. that we get a cut of growth expectations because of how much the Fed is tightening and how much that will impinge on the economy. That is beginning to make sense to me, that it's only from really oversold levels that we can get a rally in commodities. Nothing bullish about the oil chart. You know, it just can't get up above 75 when it keeps on failing. And therefore, I still believe that just like DBC needs to make new lows to get everybody bearsed up, so does oil need to make a new low around, below 60, possibly go all the way down to 52. I mean, that's entirely possible. And it's from those levels that it can rally. That's, I'm just telling you what I see. I see no reason to step in and buy it at the moment. And if I can't be buying oil, then I really must think that the bonds are going to go to the levels that I showed you. And then that is going to precipitate selling of all the commodities into my targets, because everybody will say, well, the Fed is going to kill the economy. From my clean chart, it's been working very well. Let's see if we can enlarge this. Unless and until it breaks 42.55, the path of least resistance is higher. But we've achieved that 43.25 level that I was telling you was also important. And so now we are in absolutely no man's land. Let's try to figure this out logically. I've been telling you that I expect the Fed to hike the GDP numbers, to hike their inflation numbers, and to lower the unemployment expected for December 2023, and therefore to signal at least one more hike, if not 2 hikes in 2023, and a postponement of the easing in 2024. Now that has 2 effects on equities. One, it has the effect of lowering economic activity in the future, but also it has the effect of higher rates for longer and therefore lowering the multiple. So it also has the effect of having the prospect of more growth in the short term, which should support the earnings. So the effect is not as bad as it is on bonds, but it also is bad because lowering of the multiple is going to be bad. So I don't expect equities to do all that much on the upside. I think any spike on, let's say, on the Fed does nothing, but then they read the dot plots, any spike I will leave offers above this 43.25 area, simply because I think the odds of it returning to 42.55 are far too high. And really the level that I will be interested in is this one, the 41.66 to 41.81 level. That is the only level that I think would hold or has a potential to hold. If we start going down hard on what the Fed has done, I don't think 42.55 holds. If we look at another daily chart of the SPX, you can see why I don't think that 42.55 will hold. This is the very important monthly 41.81. And I really would not be surprised if at the end of the month we're there. But, there we are. So, if we on Wednesday get down to 42.55 area, we will be breaking the moving average. To me, then the natural support again becomes this 41.81 to 41.65 area. So I think next week is going to be more volatile than most. I see very little prospect for us retaining and staying at these levels. Anything above 43.50 to me is a clear sell or a clear buy put spreads all the way down to this level. I think the risk reward for next week is going to be to the downside in equities, because I don't think, even though equities should be preferred to bonds, I just don't think they can resist the everybody A being bullish and B the fact now. I mean, now that we've moved so far up, everyone is bullish, but I don't think they can resist the multiple compression. And the fact that they have to discount that this kind of hawkishness from the Fed in the longer term has to have an impinge on the economy. It just has to. I think equities on a dot plot, which is around 435 to 445 area for 2023 and a little bit higher for 2024, have to give up a couple of percent. Weekly chart of the Nasdaq. What's interesting is that while XLK made a doji weekly candle the week before, QQQ and the Nasdaq have made one this week. So what is that telling me? That is telling me hesitation, and we are at the upper end of the Bollinger Bands on the weeklies, and therefore what is unlikely is that we break higher and stay higher. If we break higher, we will come back. I'm absolutely certain of that. Where will we come back to? Well, the first level is always the level of the break of the Bollinger Bands, and that is 14,100, 14,150. Okay, so a new low, breaking the low of these weeks, and then we can see. But to me, the natural point is 13,800. And if we have a look at the other level, at the other charts, and let's have a look at the 195-minute chart, we see how much we're struggling to break this, to fill this gap, because all the offers are here, right? This market isn't going to fill you here and then return down. It's going to tease you and make you sell down here and then go and fill the gap without you. So to me, the natural level is around this 13,800 something. Possibly get everybody bearsed up and go and fill some of this gap to 13,700 and then move higher. So I think next week the odds overwhelmingly, from a macro perspective and from a technical perspective, favor, if what I have been saying does happen and the Fed does what I expect it to do, then the odds are overwhelming that we get higher volatility to the downside. The reason why I can't expect a complete debacle in equities is because the Nikkei is still so strong. What have I told you? I've told you that, equities could come back a couple of percent, but that there will be buyers down there. So much the same as happened in Nikkei last week. We had, that scare. It got down to pretty much the level that I keep on saying is support, 31,400. It, got within 50 ticks and straight back up. So, and that is because still equities are going to be favored over bonds. And if bonds aren't going to go a million miles to the upside, then equities aren't going to go a million miles to the downside. I think really it's as simple as that. And that any dip next week down to 31,000 odd on the back of what the US does is going to be another buy for Nikkei. Enough theory. We will see what the Fed does. I've told you what to look out for in the dot plots. I've told you what to look out for in 2024 and 2025. I think those are going to be just as important for what the yield curve does as the immediate, whether they've hiked rates by 25 in June or not. I think that's probably the least important. I think the dot plots are going to be far more important, and I think their economic projections for 2024 and 2025 are going to be just as important as the dot plots. I still expect the yield curve to flatten to the levels that are indicated. The twos are still my least favored area, the one where I can see the least risk reward. From levels, I can see very good risk reward in earning 5s and 10s, but I've showed you those levels and they're not here yet. I can't get bullish of the euro at the moment. Because I can't get bearish of the dollar just yet. I think it needs higher levels before that can happen because of interest rate differentials. And therefore, I'm not bullish of gold. I think the odds of it breaking down are higher than the odds of going up. But the uncertainty there is going up. I think the uncertainty as to everything has to go up, especially because we have reached the levels that I kept on telling you that we would reach in the equities. 43.25 was the second area. Well, we got within a tick of it. So what are we supposed to do at these levels? I think at these levels, any kind of spike, it's a natural for you to go and buy put spreads. Right, thank you very much indeed. Have a wonderful weekend and tweet you on Monday. It's going to be an exciting week next week.